Hi everyone. Today I'm going to be going over a recent proposal that I created for a bid-based land value tax, which is an innovative mechanism for helping to deter negative speculation in for metaverse assets and helping increase buy-side liquidity for them. And so to get into this, let's start off by looking at what is the issue that we're trying to solve. What is the big problem that is coming to the metaverse here? And that's the issue of speculation. And drill down to a certain type of speculation here. That's often referred to when we're talking about physical land as squatting. And this is the idea where someone will buy up an asset and their goal is to just wait for its price to appreciate and then sell it or maybe rent it, but they're not going to actively do anything with it. If we're talking about a piece of metaverse land, the buyer is going to buy it because they think the price is going to go up, but they're not actually going to build anything. They're not going to build a house on it or build a business or do anything that is going to help grow the ecosystem. And when this happens in mass with a large number of participants doing this, then we have an issue where in the long run, not enough people are actually building in this metaverse, and that can make it stagnant and lead to overall failure. It also means that there's not much revenue going towards the DAO that's helping to fund this particular project. And so we want to try to solve that issue and push these metaverse assets into the hands of the people who are actually going to build and create value within that economy. So looking at the first component of the idea, and that's the concept of a land value tax. And land value taxes are not new. They have been around the concept's been around since the 19th century from the author Henry George, who conceptualized this idea for physical land. If you're going to tax land, if you're going to tax real estate, what's often done is taxing both the land and the house that's built on top of it. But the downside of taxing anything that's built on top of the land is that it's creating a bit of a disincentive for doing that construction. Because if you build a really nice house, but then you're taxed on the increase in value from creating that house, it's a bit of a disincentive for that production. And so it's more effective to focus on taxing just the land itself and not anything that's built on top of it. So it's taking this concept and then applying it to the metaverse, where we're looking only at this base level asset. So this could be conceptualized as a piece of land in the metaverse, and not something that's built on top of it. And so now that we're focusing just on the land itself, now we need to figure out, how do you actually value that land? Because you need to figure out what that value is in order to tax it. And there are a variety of different strategies for assessing the valuation of assets. Some that have been brought up are the idea of comparable assessment. So looking at what are other similar assets selling for, but this can be a little bit difficult when we're talking about NFT markets, where inherently these assets are non-fungible. They're not exactly the same, but you can still look at the different traits between them. For example, land that's in a very similar area, or NFT characters with some similar traits. But the downside is that there's the potential for wash trading to try to manipulate some of this valuation, where you could wash trade assets with a certain trait in order to try to reduce your own taxes or increase them for a competitor. Then another direction that's been very commonly discussed is the idea of a Harburger Tax. And so with a Harburger Tax, it's based around the idea of self-assessment. So it's saying that whoever currently owns this land, this NFT, states their own valuation for it. So they say, I think this piece of land is worth $100. And then that means there'll be some set tax rate applied to that $100 valuation. And then that is going to be the amount that they're taxed at over time for holding the asset. But there's a bit of a catch to this, in that at any time, anyone can purchase that asset for $100 or for whatever price they said, and there's nothing the owner can do about it. And so it has the downside of undercutting sort of that true ownership that is very important with the concept of true ownership in NFTs. If you can lose it at any time, that can be a really big barrier to participants wanting to join this economy. And so that ability to lose it at any time, or needing to constantly stay on top of your valuation, or even having a good assessment of the value of your own asset in the first place, can be very difficult, especially with the price NFT market prices moving around constantly. So in an NFT context, this is a very, very difficult option, and likely is not viable. And so wanted to move away from this concept of self-valuation. And so now getting back to my proposal. And so my proposal is for a bid-based land value tax. And now, instead of relying on that self-valuation, looking at what is someone actually willing to pay for this NFT. And so looking at valuing based on a current bid. And so looking at whatever the highest current bid for this asset is the rate it will be taxed at. So if I own a piece of land and someone bid $90 on it, and that bid is currently open, and so I could accept that offer right now for $90, but I have the choice of either accepting that offer or being taxed at that valuation. And so you have that trade-off where speculators, now there's a tax being forced upon them. And so they're given that choice of either do they accept that money, or do they have this ongoing cost that is not that makes it difficult for them to hold on to that asset for speculation, because someone who might actually be willing to, for example, start a business on that piece of land, they are going to value it higher, and so they're going to be willing to pay more, and and their bid will impose a cost through the taxes on the speculator, and so that makes them likely to want to accept that bid. And so now you have land that's in the hands of someone who's actually going to be build something useful on top of it. But then this brings up the question of how you ensure that people are making bids that are reasonable that represent kind of the real value of that asset, or what they're actually willing to pay for it, versus in the current scenario for NFTs, there's often very low or no bids for a lot of the assets that are up, just because they're non-fungible. There's so many of them, and there's also an opportunity cost to having your bid up over time if no one's going to potentially accept it. And so this means that often if it can take a very long time to sell your NFT, because there's no liquidity of buyers putting bids up that can be taken, as you find with most cryptocurrencies, those being fungible tokens. And so the additional component of my proposal aims to solve that aspect, and that is taking a portion of the tax revenue from this bid-based land value tax, and then giving that to those who leave their bids up, specifically the highest bidder. And so that means that there's an incentive to bid up to what you really willing to pay for that piece of land, because either your bid will be accepted and you'll actually get that piece of land, or you'll have this revenue stream of tax revenue from the current owner. And so that's an incentive for people to compete with each other and competitively bid. And this creates price discovery, as well as incentivizing liquidity for non-fungible assets, which is a huge step forward for the NFT market in general, given the current significant lack of liquidity that might prevent a lot of people from wanting to enter the space. And so just to contextualize this a little bit more, and so I mentioned how you could do this for Metaverse land, and so getting someone to build in your land-based Metaverse and push out speculators. But this doesn't have to only be talking about virtual land. This can really be applied to any assets that are that have some reason that they have to be scarce. Land has to be scarce if you're talking about land with a specific location, because if you're, for example, in a city, the benefits of being in the city are based around proximity to other things. And so if you continue to expand that supply of land, eventually you're just talking about land that's way out, far away from the city, and is not really the same. And so that's a reason you can't have, there's kind of a limited land supply. But this also can apply to, say, NFT heroes or characters in a game, where there might be some commitment to early investors that you can't create more heroes, and that these heroes might have some sort of financial earning component to them, and speculators likely would buy them up, expecting some or hoping for some growth in the price of these assets, but they're speculators. They don't have any intention of actually playing the game. And so suddenly you have a bunch of people who are sitting on the assets, not actually playing, and that negatively harms the whole ecosystem. So here you could implement a bid-based land value tax, and in doing so, you can split that base hero from, say, any upgrades that it has. That being, because the upgrades would be the improvements. It would be what you get from doing the desirable activity of actually playing with the character. And so if you were to tax the entire amount, so including the upgrades, then it would be a disincentive for playing. But in this case, we're focusing just on the base hero, and we're doing this by splitting the bids. So when you want to bid in this market, you would create two bids, one on the hero and one on the upgrades on it. And so these could be accepted independently. And that allows us to look at the bid for the base hero and use that as the valuation for taxing the hero. And now you have a scenario where speculators have this ongoing cost of holding the hero, so they would be pushed towards selling the hero to someone who is actually going to play with it. And given that they're expecting some revenue from playing, they're going to be willing to bid and have a higher valuation than just the speculator. And so that you end up with the long run result of, now you have a community of hero holders that are actually playing the game and helping to grow the project. And so just in terms of overall benefits for the bid-based land value tax, the goal here is really to combat speculation. So this helps with the ongoing growth of the project. That has benefits around predictability for planning, because unlike a Harburger Tax model, the decision to sell is always up to the owner of the NFT. So it's just giving them a choice between a tax or a buyout, versus having a forced buyout scenario. And there's also no need for bureaucracy. So if you had a valuation model that's just based on comparables, then you might need some bureaucracy for handling like an appeals process, but none of that's required in this scenario. And then there's a concept here around you're now able to collect tax revenue from ownership of an asset rather than just the sale of an asset, which is really big, because currently if you think about DAO revenues for Metaverse projects, they're funded by people selling. They're funded by people exiting the ecosystem. That has a lot of misaligned incentives there, because if the DAO really wants to grow in the long term, they should be able to benefit from the people who are sticking around and building, rather than just those who are leaving. And so that if they're able to monetize from people who are actually building and owning rather than selling, then that is going to be much better incentive alignment for them in terms of the decisions that the DAO makes to ensure its long-term funding. This matches up well with what traditional governments do. They don't just have sales taxes, but they also have ongoing taxes on your ownership of assets, like ownership of your house, even though they may do property taxes, which is a little less well targeted than a land value tax. And then also you have the incentives for liquidity really help with bringing more people into the NFT space, because it opens up doors for further financialization. Like if you have an NFT, this improves your ability to liquidate it quickly. So it opens up the door for NFT collateralized lending to be more efficient, and just have bigger players who were concerned about asset liquidity risk now being more interested in stepping in and participating in these markets. There's also benefits around high allocative efficiency, or the concept that the person who values the asset the most is going to be the one that gets it, and that is present in this model. And there's also high investment efficiency. So you're only taxing the base asset rather than the improvements, and so there's no disincentive for investing in the growth or building on your asset. And so hope that this concept of a bid-based land value tax is useful to as a tool to consider for those out there who are considering building metaverse economies and potentially see the issue of speculation now or at some point in the future. So keep this in mind as a tool to use. And if you need any assistance in designing a bid-based land value tax or other mechanism in a Web3 context, feel free to reach out to Economics Design.